The price of cars, especially used cars, were one of those surprise things that went up in value during 2020 and continued to go up in value during 2021. It seemed like there was a mad scramble to buy any car you could at any price, and they just went up. In fact, used cars outperformed things like Bitcoin and gold and stocks and real estate. It was absolute craziness. So the question now is, was that sustainable? Is that going to continue? And what is happening now, given the fact that many people are starting to talk about a subprime auto loan crisis, where people are starting to be delinquent and default on their auto loans? Ready? Let's dive in. If you're in the California area, I'd love to see you at Pacific Bitcoin in November, on November 10th and 11th in Los Angeles. The Pacific Bitcoin Conference is going on. I'll be speaking there. Michael Saylor called it the event of the year. Going to have a ton of great speakers like Alex Epstein, Lynn Alden, Jeff Booth, Robert Breedlove, my friend Mark Moss, and many more. If you can make it, I'd love to see you there. A discount link is for you in the description below. You got to use promo code Heresy and you'll get a big discount on your tickets. Okay, take a look with me at this chart. This is the Manheim Used Vehicle Value Index, and you can see that the price of used vehicles relatively stable from about 1995 through 2020. Yes, there are some ups and downs, but the overall trend was very, very predictable. Then suddenly something snaps, something changes, and the price of used vehicles in the United States just absolutely rockets to the moon. Now, obviously, there were many things going on here. Number one, cars are a consumable product. They break just by themselves, and they also break from getting in accidents. And so the car fleet, the total fleet of vehicles in a country, if all else stays the same, will just continue to dwindle over time. They're used up, they're consumables. To counteract this trend, you have to make more cars, and so the fleet has to at least be replaced at the same rate as it's getting depleted. Well, obviously, some things happened in 2020 that stopped that from happening. Number one, supply chain issues. So new cars stopped being made at the same rate as they were because it was harder to source things, harder to source labor, materials, to continue to making cars at the same rate we were making them before. One of the big contributing factors to this was computer chips, because we all know about the chip shortage. That was especially true in 2020 and 2021, and all new cars these days are made with computer chips. So you had massive car lots full of brand new cars that were fully built, just waiting on one or two computer chips to be put inside them so that they could start working. And so supply for cars just started to actively dwindle as the depleted fleet was not getting replaced as fast as it usually had been. The other thing going on here was increased demand, because suddenly you had people that got a lot more money. You had people that got stimulus checks. You had people that refinanced their mortgages, so they have less expenses now. Cash out refinances, so they got a big lump sum of cash. And so people were looking around and thinking, hey, I want a new car. And so people went out and tried to buy new cars, or at least upgrade to used cars that were better than the cars that they had. On top of this, the influx of cash allowed many people to be able to pay off some of their debt, giving their credit scores a higher credit rating so that they could qualify for more debt on cars that they might have not used to be able to qualify for. So all of these factors contributing to increasing the demand for cars and lowering the supply of cars. But as we can see here, the trend looks like it has broken, and up until about this point on the trend, it looked like that might have been just another retracement before another leg up. But right about here, we saw this trend start to break and head back down. So what changed here, and why are the price of cars seemingly starting to crash now? And you have to keep this in historical perspective, because when I say crash, I mean from the top. Cars are still pretty expensive compared to where they were a year ago, 2 years ago, 3 years ago, especially. So let's look at this article from the Consumer Financial Protection Bureau, consumerfinance.gov. This came out September 19th, and they report in here some charts that we're going to take a look at. Number one, July of 2022, the average price that consumers paid for new vehicles did reach a record high. So new vehicles still going up in price. price on average. And here's your no shit Sherlock moment for the day. The Federal Reserve put their brilliant minds to work and found that higher vehicle prices are a significant factor driving larger loan amounts. Really? It took hundreds of PhDs to come to the conclusion that higher car prices are going to be associated with larger loans. All right, and if we take a look at this chart, we can see a couple of things here. So it's going to break down by credit score basically here. So we've got prime borrowers, near prime, subprime, and deep subprime. And we can see the amount that they finance on average in thousands. So obviously the higher credit scores are going to be financing a lot more, but ultimately right around here, we see a departure from the trend where the amount financed starts to go up. But we do since the beginning of this year, we've seen these trends start to flatline again a little bit. Now, credit scores going up from people being able to pay down some of their debt, that did contribute to people being able to afford larger car prices. However, that wasn't the only factor. Longer term for the loan was actually a big contributing factor as well. We can see here that the amount of months, number of months, the length of the car loan, right about here started to take off, departed from the trend, and people started taking on longer and longer loans right around here, and it really started to skyrocket compared to the average trend before. Along with all of that, you would still expect an increase in monthly payments, and that's exactly what we see again starting in 2020, an increase in the monthly payments on average for every single credit. And now we're going to get into some of the more frightening charts or charts that show that we might have some trouble in the car markets coming up soon here. Keep in mind, direction is more important than current location. If we take a look at auto loan delinquency rates, we can see a clear change about halfway through 2021 here, where delinquency rates started to rise again at a faster pace than they were declining from 2020. Obviously, the lower credit percentiles are going to be increasing in their delinquencies more. These are going to be the first people who are going to default, the people with the worst ability to pay back their loans. So obviously, we are seeing that accelerate faster. Now, it's still not at the point that it was during 2017, 18, and 19 here, but the trend is increasing quickly. So it could be just a few months or a few quarters before we get up to levels above what was normal in the pre-pandemic era. Now take a look at this chart with me here, and this one I'll have to explain it a little bit. So each one of these lines represents a year. So each different colored line represents a different year. And the numbers on the bottom here represent how many quarters it's been since the loan started. So when we get all the way out here, it's been 8 quarters since the loan started here. So we're looking at each year what the delinquency rate is as you move forward in time 2 years from the original year. So 2020, let's start with green, 2017. We can see 8 quarters later, car loans had a delinquency rate right about 0.75. We can see here that 2018 was a little bit higher, 2019 was a little bit lower, 2020 is obviously going to be the lowest there because that's when everybody got their cash infusions, but 2021 here showed that it it started off lower here, but once the cash ran out, it started accelerating faster, higher than every year before it. Now, we are not yet 8 quarters out from the loans that started in 2021, so we'll have to wait to see where this ends up. But the scary thing here is if we take a look at the 2022 line here, we're 2 quarters out here, and it is above the trend line of all of the other years combined. We can further break down their charts and look at just deep subprime and subprime here, and we see this even more clearly here. So let's look at deep subprime because that's going to be where the issues are going to start first and be the worst. We can look at 2017 is the green line, 2018 is about the same as 2017, and then 2019 it got a lot better. 2020 it was worse, and then we can see here it continues to get worse as we move forward. So this is going to be 2021, the purple line here, and then 2022 over here. So we can see that again, same thing happened. 2021 started off better, and then it got worse towards as you add on more quarters here, and 2022 is shaping up to be the worst of all. Now, what happens to these cars as they get defaulted on, as those delinquency rates get worse? Eventually, the cars are repossessed by the banks. The repo guys come and they grab them, and this is repo like repossessed, not repo repo, like the repo market, the repurchase agreement market, like we talk about a lot on this channel here. So those cars will get repossessed, and that's going to increase the supply. So this trend that we see here of used cars falling in value, this should continue now. We should see a reversal of everything that happened in 2020 and 2021 as more and more cars come back onto the market to get resold, and fewer people can afford to buy them because rates are increasing so quickly and credit scores are reversing back to where they were before people got the stimmy checks and the refinances to increase their own credit scores, going back to where they were. So affordability for cars is starting to crash. So as long as this continues, we should see more and more affordability of cars. So if you're in the market for a used car, things are starting to look good for you. Things are starting to look up. This is why I always say deflation is good for people, because if you play it smart, if you play it wise, if you are not risky, if you're not aggressive, if you save, and if you play it financially responsibly, then deflation benefits you. You want the system to incentivize being smart with your money, not being reckless with your money. And so the more and more we have of this, the better and better off the entire society, the entire economy will become long term. So for those of you who have been waiting on the sidelines, thinking you missed the boat, maybe not. Boat might be coming back around one more time, just as long as we don't get another Fed bailout anytime soon. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.